Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Chris Picciurro. He is a CPA, he's an MBA, he's a PFS, and an ARA. I'll have to ask you, Chris, in a minute about all those different designations. I know some of them, but Chris is a highly respected expert in U.S.-based tax planning and strategies for real estate investors with international recognition as a presenter on the subject. He's based out of Franklin, Tennessee, which is just south of Nashville, Tennessee, where he currently resides with his family. He also served on the Intuit Tax Council between 2017 and 2020. He's an active member of several professional organizations such as the MICPA Task Force Leadership, the TNCPA, so Tennessee CPA, the NAR PM, and Dave Ramsey. He's also the co-founder and executive officer of Integrated CPA Group and the founder of Teaching Tax Flow and the monthly reoccurring Revenue Institute. So Chris, welcome to The Wealth Flow.
Keith, it is an honor to be here. I'm really excited. We must be kindred spirits because we both put flow into what we do in our company name.
That's right.
And yeah, I'm really excited to talk about tax planning and strategy and legally and ethically reducing tax someone pays in their lifetime and how to do that. So I'm a firm believer that anyone can benefit from tax planning and strategy. And one of the myths are that you have to be high income or high net worth to take advantage of things. So it's an honor to be here. I've got a couple of accreditations. All it really means is that I've been doing this for a long time.
There you go. That's fair enough. And Chris, tell me a little bit. I always, with every guest, just more of a curiosity. I always love to find out where you grew up and, kind of what eventually led you, in this case, to, being a tax professional.
Right. Well, my wife and I, we have 3 children. They're 15, 14, and 11 at the time of this recording. And both my wife and I grew up just outside of Detroit. Luckily, we didn't know each other when we grew up. We didn't meet until we were both done with college. And because if we had met any earlier, she wouldn't be my wife because I probably wasn't very good marriage material at that point. But by the grace of God, we were introduced. She was a great referral. I got referred to her. And
that's awesome.
Yeah, we got set up together by mutual friends, and so it all worked out. But I grew up in just outside Detroit, in Mount Clemens. Mount Clemens became Clinton Township, and just like every child growing up in Detroit, you would throw the baseball in your front yard with your dad or mom, and you'd say, I can't wait to grow up and be an accountant. That's what everyone wants to do, right?
Oh, for sure.
But no, that was not the case. But grew up outside Detroit, a huge Detroit Tiger fan. I'm going to age myself a little bit, but I grew up in the bad boy era. They were my team, the Detroit Pistons. And then I'm a huge Michigan State Spartan fan. I went to Michigan State for my bachelor's. But once we moved to Tennessee, we moved here to Franklin 8 years ago, and our family adopted the Titans as kind of our team here. So, ultimately, because of our CPA practice really niching into helping real estate investors and not necessarily having to be anywhere geographically, my wife and I about 10 years ago decided that we're gonna look around the country and figure out where the best place to raise our family is. And by the grace of God, we found Franklin, Tennessee, and it's been amazing. So that's how how we got to Tennessee. We also drove here too. So we didn't, we had a lot of stuff. But growing up, I'm kind of a little different than a lot of other tax professionals. I really consider myself more of an entrepreneur than a teacher than a CPA. Growing up, I always was, my family was very hardworking. My dad retired from Chrysler, and then my mom worked. She was at home and she worked at the elementary school. Started one of the, back in the day, the first daycare, called it Latchkey for before school and after school. She was part of that. So, but yeah, got into, being an entrepreneur at about age 13. I got the very prestigious opportunity to be a Detroit newspaper boy, which is hard. And that was amazing. I was able to have my route, and I made a lot of money, which was great. Now, I invested a lot of it into baseball cards, which is good. I still have many, many of them. But from that early age, though, understanding the responsibilities of running a business, because, now you think about first of all, not many people read the newspaper, right? I mean, it's all digital. But in those times, I mean, there was no internet, no cell phones. This is 30 years ago, 35 years ago, really. The paper boy and paper girls, well, it was mostly paper boys. We would be responsible for delivering the news to people. And we would have to get the papers, buy them wholesale from the Detroit News. I would have to load them up on my bike. And we had a lot of inclement weather in Detroit, and drive them around and deliver them to people's houses. And each person, if you wanted a lot of tips, you had to figure out where they wanted their paper. Some of them wanted the paper right under, under a mat between their storm door and their door. Everyone was different.
Mm-hmm.
So you had that responsibility, that whole buying the newspapers from the Detroit News and paying wholesale for them. But here's the crazy thing. We had to go out, because really there were no credit cards at that time. We had to go out and collect money from people. And so I had to go to people's doors, knock on their doors and collect money and reconcile manually how much they owed for their newspaper subscription. Some people were monthly payers, weekly payers. And I quickly learned that the best time, especially in a very, very blue collar neighborhood and outside of Detroit, the best time to collect was Friday after work,
right,
when people got their paycheck, or Sunday dinner time. We had a lot of Italian Americans that lived in our area, so a lot of big family gatherings. And even though our household, there was not really alcohol in my household, I knew that some of these bigger Italian families would like to have a couple of bottles of wine on Sunday, and this is a great time to knock on their door and collect. So I learned that, but ultimately realized there was a spread on the newspapers. There was money for the tips, but I also really operated my own business. So when there was a new subscriber, I would be responsible for onboarding them and that sort of stuff. So that was really, I was 13, 14, 15 years old doing that. And then that started me on my entrepreneurial journey.
Yeah. It's interesting. I always hear about folks starting, with a newspaper route. And I guess I never really, you saying that, I never recognized that a lot of times the way they operate is, paying wholesale. So you're responsible for that spread between the two. And I didn't even think about collections. So that's pretty neat. That's a heck of a job to start out with, to learn a lot about being an entrepreneur.
It was fortunately for me, the person that was before me wasn't that good at it. So I got to come in and the Detroit News asked him to stop being a paper boy. So which was good for me. And you had to apply for that. And the other cool thing was, so you can make additional money by having stuffers. So there'd be advertisements and stuff you'd stuff in the paper. I remember you got 1 penny for every stuffer you put in. And if you're listening to this podcast and you're like, why would people buy newspapers? You have to remember that the only way you knew it was on TV was to buy the weekend paper, because the TV guide was in the paper. That's the only, you didn't turn the TV on and have the TV guide right in front of you.
Right.
You had to have that paper TV guide. So the paper had a good hook for quite a while. And so the Detroit News was your afternoon paper. The Detroit Free Press was your morning paper, and I was a Detroit News. And most people like the Detroit News because especially for their sports, those morning papers went to print at probably like 6, 7, 8 at night. The scores from the night before, as baseball games and football, basketball, they weren't in the next day's morning's paper. And trust me, if you're listening to this thinking, didn't you just, no, this was only 35 years ago. This technology was not available. So people wanted that afternoon paper to get all the box scores, to get the stories of all the happenings from the day before. And the final thing with the paper was, the other thing was, if you couldn't, let's say your family was going out of town or something happened, you had to subcontract the work. So you'd have to have a friend that would be willing to do the route. They would pay them, just like anyone that's in business usually has an employee or a subcontractor, and you have to manage that labor. So it was really, Keith, it didn't really hit me, all of the skills that I was able to learn at a young age until later on in life. I'm like, looking back, like, okay. And then I'm thinking to myself, if someone knocks on our door now, you're like, I'm not answering the door. Why is someone knocking on the door? But that was, at times would be knocking on strangers' doors if they're new to the route and introducing yourself and trying to collect money from them.
Yeah, for sure. Oh, that's great. And then from there, what eventually led you to tax? I guess tell me a little bit also about how you got into taxes. Did you start as somebody preparing other people's taxes, or has it always been kind of more of a strategic role, or what does that look like?
Well, typically in the tax world, you start off preparing taxes, and Intuit had a survey, I think about a year and a half ago, where they asked tax professionals about who leads with tax planning and strategy, and unfortunately, only 18% of people. People that own tax businesses lead with tax planning and strategy, because tax planning and strategy is a complement to tax preparation. They're two completely different skills and different services that someone should consider. Now, again, they complement each other, just like a massage therapist can complement a chiropractor, but they're definitely different. And most people that get into tax planning and strategy start off preparing tax returns. So went through school. Luckily, I went to a high school that I had, I took accounting my junior year. They offered an AP accounting course. I took that. And I knew, at that point, when I realized that my future I'm never going to be on the Detroit Tigers, that I probably should stick with, and I knew I wanted to be an entrepreneur. I thought, okay, well, if I can get my CPA license, then no matter where that takes me, I'm always going to be pretty marketable. And especially growing up in the Detroit area, the job market now is completely different than before. I know you're in San Antonio, which has grown immensely over like the last 20 years. And being here in Tennessee or Nashville for almost the last 10 years, it's not too difficult to find a job. But back in those times, you've got to think about finding that job. It wasn't just a given, especially in a market that has declined as far as population and that sort of stuff over my entire lifetime. So I went to Michigan State, got in my accounting major. And while I was at Michigan State, I took my tax professor, who was nationally known and wrote textbooks and all this stuff. After I took his class, I was actually washing dishes at Brody Hall, which is one of the residence halls. And I saw an ad for a tax preparer, like the first week of January when we went back. And I'm like, I'm going to try that. So I applied for a job at Jackson Hewitt as a tax preparer. I was young. I think I was like 21 or 22. And I went to interview, like, well, you didn't take our course. I'm like, I know. But they hired me. For some reason, they hired me because I had this tax class. And that was my start. And I was going to school, but I would go prepare people's tax returns right in front of them face to face. And that got me going. But the skills that I had at other jobs of being able to interact with people face to face really helped me out. And started preparing tax returns, and then did that for like 2 seasons. And the second season, they're like, well, I was able to supervise, like they had 3 offices. It was pretty crazy. And then they asked if, when I was graduating, like if I was interested in coming to work full time. And I'm thinking probably not what I really wanted to do full time, although I appreciate the opportunity. But and that's when I started preparing tax returns. And then I went off and went to public accounting and got my CPA license and started working for a smaller firm and then a larger regional firm in the tax preparation side. Most accountants or most CPAs are either going to go on the audit side or attestation or the tax. And I definitely like the tax side. I liked working with people to get them the best result possible. So that's what got me started. And I did that for a while. And then I realized like, okay, I have this entrepreneurial spirit. I could either stick with public accounting and try to become a partner at one of these big firms, or I can just do my own practice and start my own thing. And I'd be a step sideways or backwards, but I knew that in my heart, that's what I wanted to do. So when I was 27, I basically quit my job. My parents thought I was nuts. Maybe I was. I don't know. I'm trying to think now that I'm a parent. I'm thinking to myself, Jesus, this is a good idea.
Right.
But I quit my job. I made sure that I had bought my first house or condo. I bought a car because I knew once I quit my job, it was going to be a while until I'd be able to easily get credit, and started my practice when I was 27, and then started preparing tax returns.
And somewhere in all that, Chris, you went from, preparing just, doing general returns to kind of having a focus on real estate. And I'm sure you're probably going to get to that, but I'm curious what, kind of had you focus in on that particular area.
Right. Well, I always enjoyed real estate. And I mean, even, I used to play Monopoly when I was like 5 and 6 years old with my older cousins. And by the time I was 7, they allowed me to be the banker. And that was like an honor to me. And my cousins were all older than me, that were playing. And I just loved real estate. It's just very interesting to me. So when I started my own CPA practice, just like many people that just get started, as long as it's legal and someone's going to pay you, you're going to do it. You didn't have a client acquisition process. It was, hey, can you prepare my tax returns? Sure, I'll do them. Here's how much it is. And that was fine. It got me by, but I really didn't love feeling like I'm doing a compliance task. I'm not doing anything proactive for them. I'm not adding a ton of value. So quite a few years, into that, I realized, all right, we built up a pretty big practice but I was just turning and burning, and I started having a family and I'm missing out on things. And I said, I think in the long run, I want to niche and run a CPA practice that's completely subscription based, that focuses on real estate investors, that includes tax planning and strategy as part of someone's membership on top of the tax preparation. And I felt like with real estate investors, I just had a passion for them. And one of the things we talk about in teaching tax flow is that the tax laws are written to encourage and discourage certain behavior, and that certain industries are very tax advantaged. Well, real estate, in my opinion, is one of the top 3 industries as far as being tax advantaged. So if I'm going to do tax planning and strategy, I want to pick an industry that there's a lot of opportunities available to people that are in that industry. So that's what really, plus I had the love for real estate, and that's what really got me down that rabbit hole. So I've been in practice now over 22 years. I'd say the first 5 to 7, very much a generalist. Then I had a little bit of a transitional time, but over the last decade, it's been really focused on tax planning and strategy for real estate investors. And that's, that kind of got me down this niche, I guess you could say.
Yeah.
And if you're in a profession, if you have a professional service, niching down is really powerful, because you can, you can utilize your skills and deploy things quicker because every client's unique, but ultimately you've got to, they're dealing with many of the same issues. So working through all this focusing on tax planning and strategy, it was working. I was like, wow, I was able to help save this person $15,000, $20,000, $3,000, now hundreds of thousands of dollars. And that felt great. I loved it. I was like, this is amazing. And I had a certain way that I was explaining things to people that seemed to be working, that people seemed to understand. And with tax planning and strategy. And that's what really got me into saying, okay, well, this is working. What is this? And I'm like, okay, well, it seems like real estate investors and business owners and people understand cash flow, but they don't really understand the tax ramifications of their decisions. So let's call my process tax flow, teaching tax flow.
Yeah.
And ultimately, tax flow it's the tax benefit or burden of all of your financial decisions. Everything we do financially has a tax consequence. Some of them are positive for us. Some of them are a detriment to us. And once we understand that, so once I named our process teaching tax flow, then if we started applying it not just to real estate investors, but you can apply teaching tax flows concepts to any taxpayer now. And that feels good. So now we've been building a community. We have a podcast that keeps growing every month, thankfully, and in growing our network of tax professionals, of taxpayers, and implementation partners. So people that help implement the tax strategies, because we can go on a TikTok, we can go on Instagram, we can go anywhere. Tax strategies are cheap, but tax implementation is valuable.
For sure. Yeah, and the strategy piece of it is extremely valuable. Chris, maybe if we can talk about just different things that you see that maybe sometimes is an afterthought for folks that could get them in trouble, or that is just a really good opportunity for them to save taxes if they were to implement certain strategies. So maybe what are some of the top ones that you really see in your day-to-day?
Absolutely. Well, here's the situation with tax planning and strategy. It's hard for people to understand that because it's kind of an intangible thing. So if you're listening and you're a taxpayer or a tax professional, what we have to understand is you need to have some type of process for figuring out what is appropriate for you. So in teaching tax flow, I'll briefly go through our 3 laws. There's 3 laws. We have one that your tax return should be a verb and not a noun. Taxes are something you should be thinking about all year round. It's not something that you give a stack of documents, or hopefully you upload documents to some type of portal for a tax professional and you say a prayer and hope you get a good result. You got to understand, someone is going to pick your tax, either you or the government. And if you're listening right now and you're not picking your own tax, that means the government's picking your tax. You pick your tax by changing your behaviors, changing your actions. So one is your tax return is a verb, not a noun. Our second law is that tax agencies are your involuntary business partner. We already talked about how laws are written to encourage and discourage certain behavior. And the third one is there's a difference between cash flow and tax flow. An example would be, I bought a property or short-term rental property. Some people have heard about the short-term tax loophole. I bought a property and it's cash flowing the first year of plus 20,000. But with a cost segregation study, it's showing up as minus 90,000 on your tax return. There's a difference between your taxable income and the actual cash that goes in your pocket. So those are the 3 laws. And I'm going to briefly talk about the 4 steps of tax planning. And then I'm going to tell you my favorites, because I want to preface this. The first one is you have to diagnose your situation. We teach 4 different diagnoses. They are color coded because people understand colors. If I start talking about section this, that, I'm going to lose, or who cares what line something is on the tax return? That does not impress me, and shouldn't impress you if you're tax professionals. Oh yeah, you put that on line 11, big deal. All that matters is what's the net effect? Are you getting the best result possible legally and ethically in your tax return? So we try to use color-coded diagnoses to try to make people understand their tax situation. In the KPI you have to understand in tax planning is marginal tax rate. Marginal tax rate is the more important than your tax bracket, because marginal tax rate is ultimately how much tax you're paying on your next dollar. Because you can be phased out of earned income credits and child tax credits and student loan interest deductions and mortgage interest deductions, stuff like that. But so you diagnose yourself using a color-coded diagnosis. We have 4: red, high marginal tax rate; gold or green, low marginal tax rate; purple, tax deferral; and then gold, tax-free income and growth. So red, green, purple, gold. Once I diagnose someone based on their marginal tax rate, then we look at different prescriptions. After we identify prescriptions, then we do something that we have some IP on called an IQ test: identify strategy, quantify result. Let's make sure this makes sense financially. Let's make sure this makes sense liquidity-wise for you. We don't want the tax tail wagging the dog. Finally, implementation. That's very, very important. So, Keith, let's start with my favorite, red diagnosis. So red diagnosis is high marginal tax rate, especially if you live in a state with a state income tax. Keith, luckily you and I do not live in a state with a state income tax, and that's part of the reason we moved here. But for someone that's a real estate investor, obviously the lowest hanging fruit is your cost segregation study. For someone that's in a high marginal tax rate that wants to sell their real estate, but doesn't need the cash, a 1031 exchange would make sense. Now, some of these strategies hit multiple diagnoses. For someone that maybe in a high marginal tax rate, that is an employee somewhere, then retirement plan contributions, 401k contributions and that sort of stuff would make sense. Obviously, there's tax deferral to that as well. That's for someone that's a tax deferral, a high red diagnosis. For business owners, using bonus depreciation, income shifting between related business entities. So that might mean, I'll give you an example. Let's say you're a plumbing contractor and you rent out a warehouse where you could put a couple trucks. You've been considering buying a facility for yourself. Well, if you buy the facility, you could pay yourself fair market value rent and do a cost segregation study on that facility. And we know that rental income is not subject to self-employment tax. So one of the things we have to remember is that different income is taxed at different rates. If someone has $150,000 worth of income taxed as a long-term capital gain, it's taxed much, much less than someone has $150,000 worth of income that's all self-employment. So income shifting to related business entities and income shifting to family members can also be a great strategy for your red diagnoses. So let's say you're real story. We have one of our clients is a doctor. His spouse, she helps out with his billing. He's just a one-man band. It's a mental health. So he doesn't have a doctor, so he doesn't have a bunch of staff and everything like that. And he was self-employed and in paying ridiculous amounts for medical expenses. And his wife legitimately helped him with the business. We ran the numbers and said, why don't you hire your spouse for a reasonable amount for someone that manages the office, and then implement what's called a Section 105 plan. That's a medical reimbursement arrangement or health reimbursement arrangement. So as an employee, he can reimburse her for every dollar of out-of-pocket medical expenses, which were $30,000 to $35,000, and take that as a business deduction, which saved him $12,000. Yes, we had to pay the payroll taxes on her wages, but they weren't that much. And because he was a high income, they decided to have a solo 401k plan, and they both put that in. So the other point I want to make is tax strategies are, they're kind of like a salad. They're not, you want to mix and match them. You want to see which ones work well together and complement each other.
Okay.
For someone that's in a lower marginal tax rate or a green diagnosis, I love those Roths. One of the misconceptions, and I think you mentioned, is that we're taught to put money away in retirement in pre-tax accounts. Well, we did some case studies. Let's say someone is a teacher. They just graduated from college. They have student loan debt. Their income is maybe, $50,000. They're not paying much tax at all, with the high standard deduction. Yet we're telling them to put money in a 401, 457 plan, 403B plan. We're telling them to put money away pre-tax. That's only giving them maybe a 5 or 10% tax benefit today. For those people, they should be doing the Roth portion. Let that grow tax-free because there'll be a better benefit. So for lower marginal tax rate clients, I love the Roth contributions or Roth conversions. Sometimes we run into people that, if you own a business, your income might be really high one year and your income might be super low the next year. We've had a client that runs a business and, they bought some equipment. Their income was going to be like negative 20,000, even though the cash flow over tax, the person's making money. It's just on pay and their tax return, they're going to have a $20,000 loss. I called them. I said, do you have any like old 401ks or IRAs? Yeah, I got 200 grand, but sitting in my old 401k. And I said, well, you can convert $100,000 of that and pay a $5,000 tax, and you have that and convert that to a Roth and never pay tax in your life again. So that person combined bonus depreciation and a Roth conversion.
Wow. Yeah,
I know a lot out there. Yeah.
It's a lot. Well, let's maybe stay on that for just a second here. That was very interesting. So when at any point can you convert, and what kind of fees are there associated with that? You mentioned 100,000. I don't know if that was kind of you'd kind of done the math on the percentage or whatever that they're going to owe, but because that's obviously, especially if you're going to have higher income later, having it where it is in the Roth, where you're not having to pay taxes again because you have cash flows or whatever might be coming in.
Right. So you can fund your Roth account in a variety of ways. So let's just talk about Roth IRAs first.
Sounds good.
You can contribute to a Roth IRA, but there are maximums. I think it's $7,000 per year unless you're 50 or older. But there are phase outs based on your income. And if you're married, your spouse's income combined with yours, and or if one or both of you are already covered by an employer-sponsored retirement plan. So Roth contributions are very limited. You have Roth conversions. A Roth conversion means you're taking money out of a pre-tax account and you're moving it or converting it to a Roth. There's no 10% early distribution penalty on that. The tax you pay in that conversion is whatever your marginal tax rate is that year. So it could be anything. Now that money's in your Roth, and there's some rules with it. It has to stay in the Roth for 5 years, but it grows tax-free as long as you make a qualified distribution at the end of the rainbow. So to answer your question, that client that I was talking about had a $20,000 loss, right? He was married with 2 children. If we took 100 grand and converted it from a traditional IRA, because he had a 401k and converted it to an IRA previously, he picks up $100,000 worth of income. His taxable income is $80,000, or his adjusted gross income is $80,000, right? The $100,000 minus 20, he's got a standard deduction of about $25,000. Now his taxable income's $55,000. He has 2 dependents where he had like the $4,000 worth of child tax credits. I'm just off the top of my head. And it worked out where he only owed like $5,000 to convert $100,000. Now, why? Because he was a green diagnosis. He had a low marginal tax rate this year. If he had $300,000 of other income, the tax on that $100,000 would be over $30,000 potentially.
Right. Okay.
So that's why the system is diagnose, prescribe. Green diagnosis, low marginal tax rate, tells me Roth conversion. And those are some, I would say good candidates for Roth conversions are going to be people that have a significantly lower income in 1 year, but they're typically higher income taxpayers. Or a lot of times you see people that were maybe executives and they get an early retirement. So let's say they're 58, 59, 60 years old. They're still 7 years away from drawing Social Security, 7 to 10 years. They have a significant amount of assets maybe they have rental properties, maybe they just have assets outside of their retirement plan. And they're going to have a small pension. Well, you might as well accelerate income, right? They're never going to be in that lower marginal tax rate again. Plus, we're still under the Tax Cuts and Jobs Act. So taxes are on sale right now, everyone. They are on sale. And we have a big election coming up this year, but as of right now, you're not going to see rates. I've been doing this for over 20 years as the lowest marginal tax rate environment we've ever been in. So for the right taxpayer, that conversion can make sense. Roth 401ks are a little different because if you're employed somewhere and you can contribute to the Roth 401k, there aren't those income restrictions. But that Roth conversion, when that's paired with something else, can be very, very powerful.
Yeah. Okay. And what are some other ones, Chris, that you see?
Sure. Well, I love gold diagnosis. I feel like everyone should be considering gold diagnosis. That's tax-free income and growth. So that includes Roth contributions. I should have said the Roth conversions are more the green diagnosis, but Roth contributions. I like health savings account contributions. A health savings account's actually both red, so it takes off your tax. The health savings account contribution, you take the dollars off your tax return, but also the money grows tax-free in that health savings account. A lot of people don't realize that your health savings account can earn interest. You could actually put investments in it if you really wanted to. 529 plan contributions also give you tax-free income and growth. And there's some new rules with 529 plans where you can take money out of your 529 plan for private K-12 schools now. And there's a one-time opportunity for you to take money out of convert money from a 529 plan into a Roth down the road. So I like the flexibility of the 529 plans has increased a lot. I also like what we call in teaching tax law advanced whole life insurance planning. Some people call it infinite banking. Some people call it people have different bulletproof banking. There's different names for it, but ultimately you're using whole life insurance to build a cash value that provides you liquidity and has some tax benefits. The other one, and this might sound funny, is selling your house, right? It's the Section 121 exclusion. So we talk about how tax laws are written to encourage and discourage certain behavior. Let's just talk about the tax advantages to owning a house right now. One, you could sell it, and if you're married, make a $500,000 profit. Now, it doesn't mean $500,000 at closing, above your cost basis, so $500 taxable gain, and not pay any tax on that. If you meet the qualifications under Section 121, which is in general, it was your primary residence for 2 out of 5 years. There's special rules and stuff, and that's a huge advantage to owning a home. 2, part of what our personal expenses are now deductible. Mortgage interest, property taxes. If you rent, none of your rent payments are deductible, unless you have a home office deduction and you're a business owner. But and then 3, the Augusta rule, right? The Augusta rule means that you can rent out your home for 14 days a year, tax-free. Now, if you're okay with people in your house, that's no problem. But the Augusta rule says, so I'm in Nashville. If I don't want to be in town for the CMA festival, which is a week long or almost a week, I can rent my house out, take my family on a nice vacation, and not pay tax on any of that money. Why is the Augusta rule was obviously derived in Augusta, Georgia, where the Masters is, where people would rent their house out. So Keith, we know that when you win an election to the House of Representatives, your term is 2 years, right? There's no coincidence that that's how long you have to own a primary residence to sell it tax-free.
Okay.
So what I do in teaching tax law and our team is we read through the rules because that tells us what to do. Imagine playing sports. Imagine playing football and going to the line of scrimmage and calling your play and not looking at the defense at all. So that's what we're doing. And if you don't do tax planning and strategy, you're not looking at the defense at all.
Yeah, that's interesting. Sometimes from somebody maybe that doesn't submerge themselves in this, all the time as their career, it's like, okay, you kind of wondered, why is it 2 years, that you, have to at least own it for? Well, there you go. You've just explained that. I had no idea about the Augusta rule. Is that actually what they call it, the Augusta rule, or?
We call it the Augusta rule. I think it's called 280A of the tax code.
Okay.
So someone in Georgia must have been in the Augusta district and probably been the linchpin to pass some other type of legislation, and they needed that senator's vote, they needed that House member's vote, and they said, let's let our constituents rent out their house for 2 weeks a year tax-free. Now, the Augusta rule could be used by business owners. You'll see this out there. Let's say if you've ever worked at a company or gone to someone's personal residence for a holiday party or for a retreat or something like that, that's a legitimate use of a primary residence in the business. So your business could pay you for use of that at fair market value for up to 14 days. So you'll see a lot of people, business owners, do retreats, do mastermind groups, do stuff at their primary residence, and then they could pay and they could take a deduction on their business for that. So again, there's a lot of bad actors out there on TikTok saying, "Hey, pay your kids." Like, I can't tell you, we have a great community in teaching tax law, but sometimes we have people saying, "Hey, I should pay my kids." And I'm like, "Oh, do you have a business?" Like, no. Okay, well, where are you going to deduct while you pay your kids? Are your kids working in the business? No. Okay, well, I mean, we legally and ethically reduce the tax you pay in your lifetime. That's what we do. When the children are working in the business, paying them there could be some tax advantages, but it's gotta be legit. We can't just willy-nilly start doing that stuff. I do want to mention one more thing I was just thinking of. For business owners, I would really make sure you're taking advantage of the home office deduction. I think a lot of people miss that, or they think that it's going to trigger an audit. We don't really get a lot of returns that we prepare audited, but if they are, I've had 2 instances where the IRS agent actually went to the home office. Of course, we evacuated the taxpayers from the house so they don't say something stupid. And both times it was allowed. It was a legit home office. So,
okay. And
yeah, so home office deduction, take advantage of that.
Yeah, for sure. Wait, one question on auditing. When they audit your taxes, if you get called on an audit because maybe they say, "Hey, this doesn't look like this deduction," are they going through like with a fine tooth comb on everything that you've filed for that year, or is it like specific? This didn't look like you could have claimed this, or how does that process work? Just
right. No, great question, because we just had an episode on our Teaching Tax Law podcast. The IRS comes out with a data book every year, and it just came out about a month ago with all the audit percentages based on income, based on a bunch of different demographics. And then we also just did, no, we didn't do that. No, we didn't do a podcast on that. I just did some content on most common IRS tax notices. So your audit risk, your raw audit risk is 1 in 200. It's about 0.45 or 0.48%. The best way, Keith, I could describe an audit in general is that it's like getting pulled over for speeding. If you get pulled over for speeding, what does a police officer do? They kind of walk around your car. They figure out if there's anything funny going on. If you roll down your window and it smells like marijuana and you've got 3 beer cans sitting in the passenger seat and no one in the passenger seat, it's going to get worse, right?
Yeah.
So in general, an examination, the examiners really just, they have marching orders to audit one specific thing or 2 specific things typically, and they're going to hit those. Give them what they want and try to limit the audit to 1 year, because you could have 3 years open and the statute. And, hopefully you don't open up a big can of worms. But if you're dodging the audit, if you're ignoring your tax notices, it's just going to get worse. Yeah. So I hope that answers your question. I know it's a weird analogy, but that's the best.
No, it was a good analogy, actually. It makes a lot of sense. And I've always just very curious on that side of it, is just as to whether it throws. You'd mentioned the home office deduction. Tell me a little bit more about that. What and this is for if you're self-employed. If you have businesses, but you're, I'll just throw myself out there.
Sure.
I'm W-2. That's my main deal, right? But I've got some other businesses as well. Part of even my W-2 work, is a lot of times working from the home office as well. I travel quite a bit for work or whatever. But I don't think I'm deducting anything. In fact, I know I'm not deducting anything for home office. I think years, and maybe 15 years ago, I might have, but haven't been. What are the rules around all that?
Right. So with the Tax Cuts and Jobs Act of 2017, the home unreimbursed employee business expenses were taken off the table. So if you're an employee, there's no home office deduction.
Okay.
Now, some employers got creative and they said, how can we compensate our employees for their home office? And they implemented what's called the Section 139 plan, where they're reimbursing all their employees for the home, the home office. So there, as a fringe benefit. But in general, that doesn't happen. So to answer your question, if you're a business owner, rental property owner, if you have a space in your home that's exclusively used as an office for a business, then you can take a deduction for that space. And you have two options. You could take the simplified method, which you're basically getting $5 per square foot. That's limited to 250 square feet. Or you're taking the actual method, where you're taking a percentage of the home office as a percentage, the square footage percentage to the home. So if you're, if you live in a smaller home, so for people that might live in like a San Francisco or New York, and they're living 1,000 square feet, and they use 200 of it as their office, then the actual method's probably going to be better instead of the simplified, where they're only going to get $600 deduction. You have that choice of which method. Now, we say tax laws are written to encourage and discourage certain behavior. The IRS, typically, if you take the simplified method, they're telling you hey, we're just going to give you the simplified method, because they don't want to weed through all of your utility bills and insurance and that sort of stuff.
Yeah.
If it's a matter of a couple dollars, I'd just go with the simplified. But if it's a significant amount, I would take the actual expense method. Something to understand too is with home office, it doesn't have to be an entire room. It just has to be the exclusive use. So some people, might have a bedroom that 50% of it is where you sleep, and the other 50% is literally a desk and a chair, and all you do there is just work. Now, some people say, well, I set my laptop up on the kitchen table. Well, guess what? You eat dinner there, and you do. So it's not exclusive use. And let me explain one more thing about home office. It's very important if you are taking a vehicle deduction. Vehicle deduction, you can either take actual expense or standard mileage to take home office if that's your primary. It also has to be your primary place of business. It doesn't have to be your only place of business, but primary place of business. Because of this, commuting miles are not deductible. So if I actually work out of my home right now, and I used to have an office a mile from my house, so I don't walk there. But your commute from home to your office is not deductible. Once you get to your office and go somewhere for business, now those miles are deductible. And when you're talking about vehicle deductions, and you have to look at your total mileage, you look at the business miles as a percent of total miles. So the point is if you don't claim home office, then your first trip to a customer or client and your last trip are simply commuting home. So a lot of times auditors will say, you'll say, well, I drove my vehicle 12,000 miles and 9,000 miles are business related. And the auditor would say, yeah, I agree with you. I could see those business related. But you're not taking home office. So I'm throwing away half of them because that first trip's all commuting. So you have to have home office, because that way the first trip you take and the last trip you come back from are business miles, which affects the deductibility of your automobile. So for people that do, let's say you're self-employed and you do manufacturers, you're a manufacturer's rep, or you're in medical sales, or you're in your professional services, you could be a notary. Think about a notary that goes all over the place, but their office is in their home.
Mm-hmm.
They have tons of mileage.
Yeah, no, that's good. What about tracking, Chris, on that? Obviously, you can keep a log, and write, hey, where you're about to take off. Here's the mileage here. Here's the mileage here. But just as kind of we've been talking, there's obviously just huge gains in technology and different things. I mean, is there any tracking that you feel works best for mileage?
Mm-hmm. Yeah, so the IRS requires you to have contemporaneous records and doesn't require you to use an app. For mileage, I personally like MileIQ. They're not one of our sponsors. We do have other apps that are sponsors, but I just like MileIQ. It's right on your phone. Once you get in the car, you can just push a button and say, this is a business trip. Because realistically, it's difficult unless you have an app that's doing it for you to keep track of all this in a spreadsheet.
Right.
I mean, you said you're in you travel a lot for work. I don't know if you have to fill out expense reports or per diem reports. So it's a struggle sometimes to remember, like, oh, gosh, I was in that city 3 weeks ago. Where are my receipts or what? Okay, when did I leave? It's like, oh my,
Exactly.
But if you had an app that tracked it all, that'd be pretty good. So I like the app for that purposes, but you're not required to use an app. I think QuickBooks, some of their versions have a mileage tracker within the app as well. So yeah, you for the mileage log, you've got to keep track of where you went, why you're meeting the person. I'm not too concerned about that because ultimately most of us have Outlook or Gmail, or we have a calendar.
Yeah.
So if I log the trip to a customer, I can go back and typically if the IRS audits you and audits your mileage, they're not going to comb through a year's worth of mileage log. They're going to sample, right? They're going to sample size a 2-week period. If things line up and you look like you have good records, again, back to the person that got pulled over, that was going 8 over. If they pull you over and you don't have your seatbelt on, okay, now things start to okay, we've got problems now, right? But if they look at a 2-week period and it seems reasonable and you've kept the mileage log, an auditor doesn't want to look through your pages and pages of mileage log.
Yeah, makes sense. Okay. And maybe what are some other ones? I know we're probably running just a little bit long, but maybe Chris, anything maybe that we haven't gotten to that you were hoping to today?
Well, I would say, for any of the listeners, try to take that mentality of being proactive with your tax planning and strategy. We have the saying, it's yours or theirs, and it's your plan or their plan, and theirs spells the IRS. And so if you want to, taxes, like I said, are on sale. It's unless you have an unlimited amount of deployable assets and capital, it's really hard to get to zero tax. That's tough.
Yeah.
But manage your marginal tax rate and really work with someone that can do the tax planning and understand that the tax planning and strategy is a complement to tax preparation. So it might be someone, if you're working with a firm, it might be someone else in the company that helps you. It might be just someone else entirely. And if you're just getting started off, and jump on. Within Teaching Tax Flow, we have a basic complimentary membership that you can look at probably 50 different videos or 5 minutes or less about different types of tax strategies, and understand that that anyone can benefit from tax planning and strategy. So it's just make sure before you do something, make sure that you go through that process of making sure it makes sense for you. So there's times when people say in our community said, "Oh, I'm doing a 1031 exchange, which is a real estate transaction where you sell property and you buy replacement property and don't pay any tax on your gain." But it includes getting a qualified intermediary, and there's certain people that have to be involved in this transaction. But sometimes people in our community say, "Well, I sold the property, I made I got $500,000 in my bank account, but don't worry, I'm doing a 1031 exchange." Well, it's too late. You can't do it that way. So make sure that you follow some type of process and figure out where you're at. Taxes, don't let the tax tail wag the dog, but taxes ultimately, if you look at it, are your biggest expense.
For sure.
So plan for those. If you're a business owner, you have more options as far as tax planning because there's different things you can do with some of the strategies we talked about. But if you're an employee and you are single or have a spouse, there's still a lot of things you could do to focus on taking these expenses that you would pay anyway and making them, pre-tax, if that makes sense. So that could be health insurance and out-of-pocket medical expenses with the health savings account, or it could be children's daycare expenses with the pre-tax dependent care contributions. That's ultimately what a lot of tax planning is.
Yeah. Okay. Sounds good. And Chris, where can people find out more about you? And if they want to connect?
Well, the best place to start is just go to chrispicciurro.com, which is going to be really hard for someone driving around to figure out even how to spell that, but I'm sure I'll get you that. Or teachingtaxflow.com. Or while you're listening to this podcast, maybe you're on iTunes or Spotify, just check out the Teaching Tax Flow podcast. We have a weekly 20-minute podcast approximately. We talk about real topics. We have guests on once in a while. And then if you like what you hear and want to be a part of our community, jump in. Finally, defeatingtaxes.com. We have a private Facebook group that is really powerful, and we get a lot of great interaction. Typically on Fridays, we have a ability for people just to post their tax questions, and we answer it within one day.
Cool. No, that's great. That sounds really good, Chris. Chris, this has always been good. I love hearing about this stuff. The more you know, I mean, it literally can save you thousands of dollars if you just know the right strategy. And as you said, you got to be proactive about it. You can't just expect that, you're going to. And the big distinction, right, between just somebody that is filing your taxes for you and somebody that's strategizing like yourself. It's a huge, huge difference. Two different people on your team. So.
Absolutely. And you're right. I mean, I'll leave it with this. Think about that teacher that I'm talking about that can just afford to put, if someone could put 10% of their income into a retirement plan, but let's assume they could put $5,000 into a Roth account and they're only 25 years old. That money's probably going to, by the time they retire, we know the rule of 72, but let's say it's going to double 5 times before they take it out. Just, what if? But that 5,000, yes, they missed out on a couple $100s worth of tax benefit today, but that 5 becomes, I shouldn't put myself on the spot and try to double things, but 5 becomes 10, 20, 40, 80, $160,000 in their retirement account tax-free.
Yeah.
So like you said, if that was in a pre-tax account, that cost about $40,000 to take out when they retire. So little decisions now, just like if you make one little turn in life, are bigger decisions down the road.
Yeah, for sure. All right, Chris, this has been great. I appreciate it. I have 2 other questions for you that I ask every guest. And the first one's really any advice you would give somebody who's maybe just starting out in their investment journey?
I would say definitely do some research, but jump in, put your toes in, start investing. A lot of times I see people that spend a lot of time and a lot of money on learning, but they don't get to the diving board and watch everyone jump off. When I first started investing, I started my first account and I committed $25 a month to investing in like drip stocks, So just do it. Even if it's $50 a month or whatever the minimum is, just start doing it. And if you're interested, and just so you can get a monthly statement and see how things flow and have, because what you're doing, just like when I was a paper boy, right? I was making a very small fraction of what I was doing, what I'm getting right now.
Mm-hmm.
But my skills were the same. So jump in. I'm not saying go tomorrow and write an offer on a house. But yeah, think about it and start. Take that one little step.
Yeah, it's great advice. I agree. And then how about a book recommendation? Doesn't necessarily have to be real estate or tax related, but it certainly can be. Just something that's been impactful for you.
Mm-hmm. Well, this one's probably been said before, but definitely Rich Dad, Poor Dad. Yeah. And even though its premise is on real estate, ultimately the principles in it really helped. And although my family was not necessarily poor at all, it was taking that mentality from the, that employee mindset to having some type of entrepreneurial spirit, and also learning, just getting your mind moving in that direction. To me, it was very impactful. So
yeah, for sure. That's a great one. It comes up quite a bit on the show, but yeah, it certainly is a really good one. All right. Well, Chris, thank you so much. And again, thanks for being on the Wealth Flow, and go check out Teaching Tax Flow, and the other podcasts, and we'll put everything in the show notes that we've talked about here. So thanks, Chris.
My pleasure. Thanks for having me.
All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.